Hi, this is ProACT Sam. Welcome to this live webinar. What requires an annual tax return is what we're looking at today. You could get a letter from your taxman that says, you need to complete a tax return. Then you know you need a tax return. But what do expats need? When do they need? What do they need? Why do they need to do a tax return? When we talk about expats, we're talking about two types of people. We're talking about people investing into the UK from outside. So they're expatriate investors in UK business, property. It could be an expat that's living as a tax resident in the UK. And what is their requirement for tax returns? Or it could be a UK domiciled expat who's living and working abroad. What is their requirement to do a tax return back in the UK? So, and each of those things are all slightly different. So what your residence is different to your tax residence, and what your tax residence is different to your domicile. And the three factors have conflicting arrangements with different types of taxes that may or may not be due under a double taxation treaty between you and or your home country. Okay, so your domicile is your home country. Now, normally that's where you're born, where your parents are from. However, your parents could be from India or Pakistan, and you're born in England. That might mean that you're still from India or Pakistan domicile. Similarly, you may have English parents but be born in Spain, but you could still be domiciled in the UK. And it depends upon a number of different circumstances, and those need to be worked out. If you're domiciled or non-domiciled, makes a difference on the type of tax returns you need to do. Just because a UK expat leaves the UK doesn't mean that they become non-domicile overnight. It takes up to 20 years to change your domicile and needs you to be tax resident in another jurisdiction for that to happen. So it's quite a complicated scenario, and it's quite a complex issue to do that. If you're non-domiciled to the UK, then you can pay a tax in the UK on UK income on a remittance basis. So your worldwide income is not taxed because you're saying that you're non-domiciled and you're doing it on a remittance basis. You may have a flat rate 30,000 tax to pay, but that's an arrangement that you need to review and decide. And ProACT offer a tax reporting service for expats living and working abroad. When you find out more details from our website at proactpartnership.com. While you're at it, don't forget to subscribe to the channel and like and share it with other people that you know who would appreciate some expat advice for living and working abroad. So domicile is one issue, and it has a big bearing on what you may or may not declare. So let's put that to one side. If you need any more help, contact us at proactpartnership.com. So the second one is now, well, let's focus on residents and non-residents. You can be resident in the UK but not tax resident. You can be tax resident in the UK, but you can be resident in another country. So we get often asked by expats is that I'm living and working abroad. How many days can I spend in the UK? How will this impact on my taxable status? If you want to be non-resident, then you need to be non-resident. If you're a UK expat or whatever your home country is, if you don't meet the non-resident rules for your home country of domicile, then you will be deemed tax resident for that country. So a UK expat who is domiciled to the UK, if they meet non-resident rules, then they can be a non-resident. They can be tax resident in another country. They'd have to be, wouldn't they? To be non-resident, and therefore they're only taxable on UK income. Okay, so if you're UK domicile and you meet the non-residence rules, and you have a tax resident in another jurisdiction, then you're only liable to tax on income or capital gains that arise in the UK. Okay? If you're resident in another country, even if you're working in that other country, even if you spend the majority of your time in that other country, if you don't meet the non-resident rules, then you're liable to UK taxation on your worldwide income or part of it. Now, so your residence or your tax resident has a bearing on this. If you can't make the black and white distinction between residents and non-residents, then the UK tax authorities have the right to dual taxation. Now, this could apply to UK expats or to expats living and working abroad, that they can apply dual residency rules. So you could be resident in the UK and resident in Portugal or Cyprus or Spain or France and taxed in both jurisdictions. Now, double taxation treaty doesn't mean that you're going to be taxed twice, 2 times. It doesn't mean you're going to be taxed twice. It means you're going to pay the higher rate of tax. So if you are trying to enjoy the non-resident status in Portugal or a lower overall tax rate, like you might get in Bulgaria, Romania, 10 or 15%, or the Cyprus 5% pension tax rate or 0% dividend tax rate that you can get in Cyprus for expats. If you're trying to enjoy one of those, but you don't meet the non-residence rules in the UK, then you're still potentially liable on your worldwide income to tax on all that income. So if you pay 5% in Cyprus on pensions, you can still pay your balance in the UK up to 45%. So if you meet the non-residence rules, you're only liable to declare tax on income and gains arising in the UK. If you don't meet non-residence rules, even if you're resident abroad, you still have a liability to your worldwide income, declaring either potentially declaring your overseas working as foreign income and potentially declaring your other income as on your UK return because it's arising in the UK. Okay, so let's get down to the basics. In the UK, if an expat is working in the UK, most employees and many self-employed contractors under the IR35 rules are paying tax at source. And under these pay-as-you-earn rules, tax at source, then there isn't necessarily an obligation to pay to complete a tax return. A self-assessment tax return is not normally required for pay-as-you-earn clients unless their income is above a certain level or unless they've got other taxable income that is known to the revenue. If the UK revenue sends you a notice to complete a return, then you must complete that return. There's no getting away with it. Even if it's a nil return, you need to sign it and say, no, I'm expat, I'm living abroad. Do not do, and that nil return will suffice. But if you get the request to complete the return, you must complete the return, otherwise at risk investigation and fines later on. If you don't get a notice to complete a return because you're expat, because you've got overseas, but you've got income anyway, you should still do that return. Now, if you don't do that return 20 years ago, the revenue might have not found, and you could have used discrete tax planning to try and not pay the tax. But discrete tax planning is not really an option. A, it's not legal, and B, exchange of information negates that. Now, we've got a guide on our website about exchange of information, the rules that came in 2015, and the long-term implications of that, which are being felt now. So, for example, if an expat has got overseas property rental, whether that's in the UK, the UAE, Spain, Cyprus, Singapore, any overseas property rental whether that's Thailand, whether it's Portugal, whether it's Florida, whether it's Spain, any overseas which you book through hotel.com or booking.com or Airbnb, all these online property rental sites are tax agents now, just the same as a tax agent in any jurisdiction, including the UK, is a tax agent now. They will deduct tax at source if they can in the UK, but they'll also do a tax report to the Inland Revenue at the end of the year. That information is shared around. So an expat living outside the UK, investing in UK property, the agent will report that income to the UK Inland Revenue. They will share that then to your country of tax residence. A UK expat that's living and working abroad, say in Cyprus, with UK property rental income, the property rental agent, whether it's Airbnb, whether it's a local property agent, will report that to a local tax authority, and then they'll report that to your tax residence. So the information will be found and it will be known, and you will have your situation to review. So, and it's the same with any other financial transaction. So if you've got a property disposal, an investment sale, a share sale, a dividend income, it all goes into tax reporting by the tax agent, the financial authority, that goes to the tax authority and then share it with your country of tax residence. So ultimately, this information is going to come through and it's going to be reviewable in terms of your tax returns. So you have to make the plans to make your tax savings and make your allowances correct. So if you choose that you want to be non-resident and you abide by those rules, then you can use a double taxation to maximize your use of allowances and minimize return. But if you've got rental income, if you've got cryptocurrency gains, if you've got investment gains on sales or trading, if you've got dividend income, if you've got bank interest or investment interest or royalties or earned income, wherever you've got that around the world, it needs to be reported. So for expats in the UK, any, for example, any crypto trading is a gain. So it needs to be reported under your capital gains. Yes, you've got an allowance in the UK, but even if you're expat, you still need to report that. Capital gains on crypto and investments and business sales in the UK and property sales are all fixed income within the UK, as is property rental income. So even if you're expat and tax returned elsewhere, you still need to do that tax return in the UK. If you don't meet non-residence rules, then dual residency taxation rules can apply, which could also tax your overseas business income or investment income as well. So you need to tread a fine line to plan how you organise your family and business affairs. You can use a corporation to get a flat rate return if you're not in a jurisdiction with a flat rate income. You can make your residence in a jurisdiction like Cyprus, where you can get 0% tax on dividends and bank interest, and there's no capital gains on investments like crypto. And be a nomad with a minimum of 60 days residence in the year. Bear in mind, under the tax residence rules as they stand today, you have to maintain somewhere to live in that country. So you need a residency visa or residency permit within the EU to get the tax number to be the tax resident in that other jurisdiction. Even within the EU, you still need the residence and the residency permit before you can get that tax number. But if you've got the income that's arising from property income, rental income, from property gains, from crypto gains, from investment gains, from dividends, from earnings, they will need reporting at some point, at some place. So it's a complex issue. We offer a tax savings report which can assess your situation. If you want to help and guide us on that, let us know. Contact us at proactpartnership.com. Otherwise, you can find out more at our website, proactpartnership.com. You can register as a ProACT retained client, either just for the advised service light or the full consultant access to the consultants to give you the reports and information, and we can help and guide you every step of the way, living and working abroad. Residents and non-residents, domicile and non-domicile, dual residence or sole residence, it's a complex issue, it's a complex pattern, and ProACT know how to guide you every step of the way. Don't forget to subscribe to our channel. Don't forget to share and like our YouTube channel. We're on a mission to help expats living and working abroad for their family and business across board and down generation. Contact us next time. Thank you.